everyone, this is Kenny Rodriguez, CEO and founder of JMC Legacy Group, Accounting and Tax. I've had several questions asked before. Should I take shareholder distribution or place myself on payroll? So I've actually did an equation behind me right here, and I'll go over everything so that you can understand the tax saving strategy and the implications of an S Corp share distribution versus payroll wages. But before we start into the equation, what is an S Corp? So Subchapter S is a way for a business corporate return to file and bypass the corporate tax rate, which could be 30% of your net profit or net income, and then having to pay taxes again on the personal side. In order to avoid double taxation, a Subchapter S bypasses double taxation. S Corp status versus wages versus distributions. We're looking at a very simple profit and loss statement. On this profit and loss statement, it's just your gross income minus the wages. So let's say, hypothetically, business brought in $200,000 in gross income. You've paid yourself $100,000 in wages. 15.3% is the FICA rate. The company pays half of that, and the other half is paid by the employee side. Employer pays 7.65%, employee pays 7.65%. $8,000 was paid federal withholding from the company's bank account. However, this is considered a credit on your wages when you file your personal tax return. So out of $200,000, wages $100,000, 15.3% of $100,000 for FICA, 8% federal withholding taken out, your profit is $76,700. Feudal taxes, $42, $76,658. This goes on to your personal tax return. Wages, you're a single filer, which puts you at a 24% tax bracket because your total income is $176,658. We're combining it with the W-2 wages of $100,000, which came from here, plus the net income goes here, total income, $176,658. Standard tax deduction for 24 for a single filer is $14,600. Minus that brings it down to taxable income of $162,058, which leaves you with a tax bill of $38,893.92. You already have a credit of $8,000 paid towards this $38,893.92, which leaves you with tax due of $30,893.92. Now, going on to shareholder distribution, S Corp distribution. We are not taking wages because we're taking a distribution. Distributions will not show up on a profit and loss statement. It will show up on your balance sheet. So $200,000 gets reported as income on a K1 schedule, K1 income, on your personal tax return, which bumps you up as a single filer to 32% versus 24%. Minus your standard deduction, because you're a single filer, which leaves you with $185,400 as the taxable income at 32%. 32% of this number gives you a tax bill of $59,328. How much are you saving? Tax due $30,893.92 on wages versus tax bill of $59,328 gives you a total savings $13,134.08. One of the main things that we like to focus on is tax planning, and a lot of times small business owners are usually on the fence of putting themselves on payroll because of the tax liabilities and the tax compliance and having to pay taxes either every 2 weeks, once a month, every 3 months. Also, there's different scenarios where maybe you're not having a great quarter and you need to know, hey, is it okay to remove myself from payroll for temporary until my profit increases versus just continuing on with shareholder distribution. So I wanted to share how much of a tax savings paying yourself through payroll versus taking out distribution. So as you could tell, you are getting a quite significant tax savings by running payroll instead of distributions. However, again, everyone's situation is different. Maybe distributions is better because of cash flow. If you guys have any more questions and you like our channel, please make sure to hit the subscribe button and hit the bell notification.